When Didi Global IPO'd 3 weeks ago on June 30th, there was no concern almost whatsoever on the regulatory side outside of the normal Chinese issues. And then just a few short days after IPO, there was a complete removal of the Didi app from the Chinese app stores. And then a week later from that, another 25 apps that Didi owns were also removed from the App Store. Since that ban in the App Store about 2 weeks ago at this point, there's been a huge drop in Didi's stock price. The stock price has dropped so low that I think that the entry point here is intriguing, and I want to talk about why I think Didi might be a buy currently and some of the risks that are associated with it. Now, jumping right into it, one of the reasons why I think Didi could be a potential buy is if we go to page 142 of the prospectus that was released pre-IPO, and we go down to, page 142, you'll go down to fair value of ordinary shares. Now, this is what they were valuing their ordinary shares at pre-IPO. Now, ordinary share is 4 ADS, or currently, if you look at what they're trading in New York Stock Exchange, it's basically this times 4, okay? So pre-IPO, they were looking at their valuation. The 3 months ended March 31st. So as of March 31st, they valued themselves at about $47.71. If you remember from one of my original videos of what I thought the problem was with Didi, was that pre-IPO, what their IPO price was going to be around $14, indicating to me that they had already appreciated by about, $14 or 14% since the March 31st date. So about 3 months, they had already appreciated about 14%. To me, that seemed a little bit off, and we needed that stock to come a little lower. They jumped up into the $16 range, and it got even a little more harder to justify the cost there. Now, I have to disclose, not only do I think it is a good buy, I actually got in around $11.60. I do think this is a good buy currently. However, with the caveat, if this does stay off the App Store for very much longer, things could potentially change. The other reason why I think, and I have to give this caveat, is this is a long-term investment. I think at least 5 years on this one, mainly because the short-term volatility here, you don't know what may happen. This could shoot down another 30%. Who knows what's going to happen? Chinese regulators are doing some pretty unpredictable stuff, and the way the market has been moving very, very violently in either direction, whatever news happens, you could potentially lose money in this position. However, currently Didi has about 90% of the market share in this space in China. Now, with that huge market share around 90%, there's the potential that it erodes during the period in which the app is banned from the App Store. This prevents new drivers from signing up, as well as new people who need a ride. So this is a very concerning, actually, it's not potentially concerning, it's very concerning, and something that has to be monitored. Now, my estimates is if this can be resolved within a 1 to a 3 month time period, again, we got about 2 weeks to 8 weeks left on that time period in order for it to remain true. Is if it lasts a little bit longer than that, I think we're kind of getting to a situation where there could be some long-term impact to their market share, as well as user trends into a different app. That is the most concerning. If we start to see trending into different apps, that stuff kind of catches on like wildfire. Apps, they are a very social type thing. I mean, people like names, and they say, people's word of mouth means a lot. So when people start moving into a different app, doing different things, it's very concerning because you can't stop that momentum once it starts. Now, for the things that I love about Didi, they're the largest ride-hailing service in the world. Yes, more than Uber, more than Lyft. They are the largest, almost $20 billion in revenue back last year in 2020. Huge company. Large market share in China, which is their core of their business and is in China. And the last piece is, with their large market share in China, they also they're well positioned geographically, because the way Chinese economy works, the way their infrastructure works, they're very well positioned for robo-taxis and any innovation there in that space. And that potentially has larger margins and a longer impact and a more of a transition from people driving themselves into more of a, riding as a service, like software as a service, ride as a service type opportunity. So I think that's a really exciting space. Now, again, that's not where they're making their money right now, but I do think they're well positioned 5 years, 10 years, 20 years into the future in order to really be one of the first companies that can get into this space. They have the backing, they have the financials, they have a good balance sheet. They just need to maintain market share, abide by regulation in China, and try not to get slapped around too much in the meantime. And I think they're going to be very well positioned. We just have to stick around long enough to make sure, see if it happens. So that's why I think Didi is a really good, good potential buy if it fits into your risk portfolio very well. Definitely make sure you look at this investment as it pertains to your total risk profile, and see if it's right for you. So hopefully you enjoyed this video. Thanks so much for watching today. Frank Finance, out.